Good afternoon. My name is Don Vivrette. I want to welcome you to It's Your Money. This is the 7th week of the series. Today we're going to talk about fixed income investing, how to use bonds. As we have said before, there's roughly 300 of you who are registered, 200 of whom overlap somewhat one to the other. Each week we've been asked, where do we get the materials? And there's been asked through this session, where do we see the videos from a result of these sessions? And it's at the same website. It's at materials.itsyourmoneyandestate.org. You click on which session you would like. In fact, let me show you this. So you click on, here is the material that we would like for It's Your Money. In this case, it happened to be week 1 that I am at. There's the link. It's again, It's Your Money and estate.org. They're all there. Generally, as you can see here, the video is the first one. If you have not signed up for Estate but would like to look at those, you can click on Estate and go down and see them. There were some questions about the charitable giving module that I had done last week, which I believe was week 5. So you can see that one, and along with David Moore. So you can see that information also. Talked about what charities are involved within that same website. There's a sponsors tab. You can go up to the sponsor tab and it will show you the various participating charities. Happy to click on those, enjoy yourself, go look at the websites, get the various pieces of information in terms of what's there, because we really appreciate their participating in this presentation. The subject today, as we say, are bonds. Next week is It's Your Mind and Your Money. If you want to check in tomorrow for It's Your Estate, you can listen to Pete and Trevor do trustee and executor duties, which should be downright entertaining to go through and do. So feel free to join us for that one. These are the locations that we normally are at, and in the spring, we dearly hope that we are again, because it's a lot nicer to be in person than it is to do it this way, at least in my opinion. So we thank all of them. These are the participating charities that we have. Again, my shout out to Chapman for the 10 consecutive years in which they've supported us, and we thank them very much, and I'm glad that David did the session with me in charitable giving last week. This is an interesting week because we have to know that I voted. So today there is no charity. The charity who was supposed to be here decided that didn't make sense because it's election day and no one would want to be here for the 78 of you who are here. So that's where we are. I'm going to stop this at this point because that's where we are. And I'm going to invite Pete to come on in. What I'm going to do, as I have done before, is you're going to use Q&A to send us messages. We'll take a look at those and ask the questions as they go along as it makes sense. And Pete will bring up Julie or talk about whatever he would like to, since there were no charities to talk about. I'm going to disappear and I will check in later. Bye.
Julie, why don't you go ahead and come online and put up your Ask First form. And I'm going to introduce you in just a little bit, but I'm going to just kind of preview the last sessions. Julie has the pleasure of doing the most difficult session, and that's going to be on fixed income and bonds. And we're going to get to her in just a little bit. Where we started off with, we gave a quiz, asked questions. Many of you wish I knew how many of you got a percentage correct, but more than likely you got quite a few wrong, and that's why you're here to learn. So the second session was about annuities and mutual funds, but the bigger picture there was that 95% of the individuals in the financial services industry is about selling product, and most of them earn commissions. Personally, for myself, if I'm going to invest my own money, I don't want a salesperson. And so I identify salespeople as brokers, and I identify individuals who are not licensed to sell and in the financial services business as financial advisors. So then we went through the financial planning, how it should be done. And we talked about the importance of understanding your objectives, understanding risk, understanding your net worth, understanding your cash flow. And then once you know that, we went into the second session on investments. And we talked about investments asset allocation. We talked about diversification between stocks, bonds, and alternatives. And today then we went into the equity session last week. Excuse me. We went into the medical care planning, because medical care planning, we need to make sure that we have enough liquidity, or we have long-term care insurance, or we have a situation where we're maybe allowed to live with our children. But we need to, for a third of us, we don't know who we are, that is a possibility. So we have to make sure we have that liquidity in our state, and we make sure that we have the person who could be our advocate when we get into Alzheimer's, a stroke, or whatever. I recommend highly that whomever is your agent or successor trustee, that they know about fee-only financial advisors, because they can help the individual plan and to make sure that you don't run out of money during your lifetime. Then we went into equities. Equities is the growth, the ownership. So, and it's more risky. So a part of your portfolio. Today we're going to go into the bonds and fixed income is the balance. And we're going to learn more about that. So Julie, you have a bachelor's degree, and what you have your bachelor's degree in?
Oh, economics.
Well, yeah, that's a perfect one. You're going to be in the financial services business. Economics is a good degree to have. How many years have you been? Well, I see it right on the screen. Tell us a little bit about the 17 years you've been in the financial services industry.
So I started locally at PIMCO there in Fashion Island, and I did a couple internships, and I was on the servicing side, and then I worked on the municipal bond trading desk for about 4 years. And then after that, right before the Great Recession, I moved to a private bank in New York, Brown Brothers Harriman, where I stayed with municipal bonds, traded their money market fund for another 4 years. And then in 2010, did a career transition, a little bit of a pivot, thought about what I wanted to do, and it was not sit on a bond desk for the rest of my life. I wanted to help individuals. So I came back to Orange County, where I was born and raised, and I was going to work with Scott, who is my partner today, but at the time said, no, thanks.
Scott is, I'm going to interrupt you for a second. Julie, I'm going to interrupt you for a second. Scott, yes. Who is Scott? Because Scott has given this presentation and you are in business with him, but more importantly, what is his relationship to you?
He is my dad. So Scott is my dad, and it confuses everybody because I call him Scott probably 90% of the time. And but we've been working together. And when we say, we've been working together on single variable algebra problems in the 5th grade, and then now we work on multivariable financial planning problems for clients. And so he does all of our tax and bookkeeping, and he's our, and consulting. But he teaches at Chapman University. He teaches undergrad accounting, and that's what he's doing today. So you're stuck with me. And but I am the one that has traded bonds. He just teaches a lot about accounting and debt management as well. So sorry we couldn't be here as a team. But yeah.
What is PIMCO known for?
They are known for bonds. They were at one point the largest bond manager in the world, and
I just wanted to give you some.
That's the story. Mm-hmm.
Yeah, I just wanted. We literally could not have a better presenter than you on, Julie, today. Look, we go to relevant licenses, and you don't have any because you don't sell anything. Is that correct? Mm-hmm. Okay,
I don't sell anything. That is correct. Mm-hmm.
Except for your services.
And I don't practice law. Yeah.
You don't practice law. You're a fiduciary. That means that you put your client's interest first before your own and you are self-employed in the sense that your company is the registered investment advisor. Is that correct?
Investment advisor.
Okay.
Yes, we are 100% independent.
Okay. And how do you charge?
So we charge $3,000 approximately for a financial plan. A little bit of complexity depends on what the situation is. Paid by, I put that in there as the client, their parent or grandparent or their trustee sometimes, right? I mean, that's sometimes the trustee comes first, the financial advisor comes second, and sometimes the financial advisor comes first. Now, for our clients, a lot of times it's the trustee is coming second because we're having those conversations about the role of a professional fiduciary over your firstborn, right? The default successor trustee. And then we also are 1% of the assets under management when we manage assets.
Okay. And you don't offer or sell annuities, mutual funds, or you don't take or give referral fees and the like. And then you do
Correct.
that. You under penalty of perjury, you signed and you got your phone number there. And hopefully you have a website and an email address at the end of the program, at the end of the slide.
Yes.
Okay, good. Okay.
Yes,
Julie, let's get into the program.
Okay, so we're going to do some PowerPoint here. I think we're going to share this screen and then give me just, 1 second to pull up the other. Oh, you know what, Pete? I have something that I wanted to share with the group today. It is, before we dive into everything, people, all clients, everybody wants to know the impact of the election on the markets, right? Well, Dimensional is one of the fund companies that we use in our asset allocation, and they have, and this link is in the slides, how much does the president have on stocks? And they've got this really cool, I love financial history, so they've got this really cool interactive chart that you can pick any of the presidents here, and you can see their party, who was in the House, inflation, a number of other things. The story is, is that what is the role that the US president has on the market? Not a whole lot. So rest easy. Everybody's going to come out a winner today, because while there might be bumps along the road, the markets are resilient because companies are resilient, and companies are resilient because people are resilient. And I just wanted to plug that before we got started today. It has nothing to do with fixed income. Maybe next year or in 4 years, they'll do something around that. But I just think it's a really neat resource with all sorts of fun, interactive information to explore. But
and the
anyway,
link for
so
that
that's
is
where
in your material.
and it's at the end of the presentation. The link to it.
Don, I didn't hear you.
So we're gonna go ahead. Yeah.
Don, did you say something?
Yeah, I just wanted to confirm that yes, the link is in the presentation.
I have it on the last page there, and so you'll if you and I wrote the whole link out. I didn't give you a short link. Yeah.
Okay.
It's there. Okay, so we're going to get started on fixed income investing. Just a little, review from last week that stocks and bonds are conduits for capital. What does that mean? Company needs to raise money. They'll take it from. They're just ways that you can invest. Stocks and bonds are the two main investment options available in the capital markets, and they're the primary methods that companies use to access capital from investors. From an investor's point of view, bonds can be considered a loan to a company. So I think that's important, versus a stock is considered ownership of a company. So when you have stock, you own a piece of the company. We have a couple of little Disneyland and a couple of little Apple shares for my son. And we have the conversation about he owns that. But there's bonds. I don't try and teach him fixed income investing yet. Due to the characteristics of each type of security, Bonds and stocks will provide different expected returns, and each plays a unique role in the portfolio. So what we're going to focus on today is the bond role in the portfolio. So what is fixed income? It broadly refers to the securities that pay interest or dividend payments until a maturity date. It's a loan to it's an investor loaning money to a company or a government or a municipality, and we'll kind of get into that, but I'm going to say company a lot, but there's a lot of borrowers out there. So it's being a lender, getting interest for a period of time, and then getting your what we call par back at maturity. So getting that fixed income amount back. It's interchanged with bonds. The owner of a bond is a creditor. The issuer of a bond is a debtor. Pete, you've asked me this before. I made it a slide this year. How big is the bond market? As of 2017, $100 trillion. It's 3 times the size of the global equity market. What that means is it's part of the credit market. Bank loans form the other main component. It is huge, and it is chopped into a lot of different pieces. Rather than when we think about our FANG stocks and how much of a percentage they share of the S&P 500, which is 500 stocks, Apple alone issues bonds of all sorts of maturities and coupons with call features, and each of those bonds makes up that 100 trillion. So it is a very big market. And I thought that quote by James Carville was kind of funny. I stumbled on that while I was preparing. I used to want to come back as any number of things, but the bond market can intimidate everybody, and that is the truth, right? Oops. So we've got, I scrolled too fast. So fixed income in a portfolio. What's its role? What do we use it for? So top 5, maybe the only 5, but definitely top 5, we've got that reduced volatility. Since fixed income has lower volatility compared to equities, what does that mean? So today equities are up, right? Bonds are going to be up less, maybe not even doing anything at all. It means that they go up and down less than equities. So some investors will use fixed income in the allocation to balance out the volatility of their stock investments. The other role that fixed income plays, many fixed income investments are traded on a regular basis and can be bought and sold easily without a major impact on price. Many investors hold these types of investments in their portfolio should they need to quickly sell in order to meet short-term liquidity needs. So it can be for liquidity purposes. High quality and short are going to be your most liquid, and we'll talk more about what makes up a bond here in a few minutes. Many bonds pay a set of coupon payments, and therefore some investors will use the coupon payments from bonds to generate income or cash flow streams to meet obligations. You can generate total return, which is the income plus the capital gain of a bond. So capital gain is the price appreciation, but they also pay coupon, and so you can get income from that. Certain types of fixed income, such as tips, are going to have an inflation hedge component. I'm not going to get into too much about tips. Like I said, there's a lot of types, but inflation protection can be one of the roles as well. And then tax sensitivity can certainly be why we would hold fixed income in terms of, so we would use municipal bonds. They can generate interest income that's tax-free at the federal and the state level. So we see a lot of municipal bonds in high net worth individuals, portfolios, and a few other places. So,
Julie, so as we get older, we don't like volatility. We need liquidity.
Mhm.
But income, it's really lacking on the bond side. So almost that issue is really reduced. And therefore, I see people not using a lot of bonds in their portfolio and forgetting the reduction of volatility and liquidity benefits of holding fixed income.
I would agree with that. And I think that right now, here we are back again to low interest rate environments, right? We have a less than 1%. So if you on the 10-year treasury right now, so if you went out and bought a 10-year treasury bond, you're going to yield 0.87%. That's not even inflation. What is that? I don't even know what that's good for, other than it is what the mortgage rate was set off, and that was a good thing, right? That low rates have some benefits. Nonetheless, rates can in theory only go in one direction, and they can only go up. I'm going to take us to the next slide, and then I'm going to come back because I want to talk about income, but now's a decent time to say price and yield in the bond world is a teeter-totter, right? So as bond yields go down, price goes up, and as price goes down, yields go up. So if our interest rate environment today is low and we can only go in one direction, what do we do with our bonds? Where does that play in our portfolio? And to your point, how do we get income without using stocks? And there's a good case for using stocks is, one of the things we talked about was a charitable gift annuity, right? Is the yield or the return, the income on a charitable gift annuity is, if you know that you're charitable minded, it's a great way to fix your income based on a distribution rate or a distribution amount, and you can set those terms. So what we're looking at is fixed income investing. I know where it fits in the portfolio to do all of these things in terms of reducing volatility, liquidity. Income, I'm not getting so much, but the structure, the type of account, like a gift annuity, certainly could be an income source. That's it too. Now, we always talk about we don't sell annuities, right? We're not salespeople, but perhaps depending on the client situation, there can be an appropriate use of an annuity. But then again, coming full circle is, if you're charitable minded, it's a great way to say, hey, I was going to give this money to charity anyway. I can put it in this special type of account, and then I can get a fixed amount of income for my lifetime or the lifetime of myself and my spouse. So I am getting that fixed income. And then what do we do in that portfolio? That's where we're still going to leverage bonds in the portfolio, but globally diversified for the long haul, able to achieve those higher income rates.
Julie?
Does that help answer your question, Pete?
Yeah. Yes, it does. Julie, do you see the yields on government bonds going like Japan below par?
I think that's a really great question. And I think the real yield, when we adjust for inflation, yes. But I think that there's enough players at play to keep that yield positive, but it is a risk. It certainly is a risk.
Okay, let's go to the next slide.
Yeah. Okay, so we talked about bond, fixed prices and yields. And there's an inverse relationship between the price of bond and yield. And I think we've covered that. So we've got some components of a bond. So what does it made up? So I have two columns here. One is all the pieces that make up the bond, and then the other is all the different types of risks. So we've got so we've got the issuer. So who issues? Treasury. Like I said, the U.S. government is an issuer. We've got GE. We've got big corporate companies issuing bonds. Apple, actually, like I said, does have issues bonds. And And then we have municipalities like the state of California. The Orange County issued bonds for the airport a long, long time ago. I do not remember if the library there that we usually meet at, right, was a bond issuance. The other thing that maybe some of the Southern California participants are familiar with are Mello-Roos. So on your property tax, you pay a Mello-Roos tax. That tax is paying a bond that was issued probably this, depending on how long your community's been around, anywhere between 10 to 40 years ago, to the county borrowed money or the city borrowed money to build the infrastructure that supports where you live. So that's the issuer. Credit rating, an issuer gets a credit rating. We have 3 rating agencies, or 2 primarily, Moody's and S&P, and they rate bonds. They give them a AAA, AA, single A, or triple B. That's going to be your investment grade, and then below triple B is going to be your junk. We've got a coupon, so that's what the interest rate that the bond is going to pay. That can range from 3% up to 8%. The higher the coupon, it has to do with more market conditions. And so what we're seeing right now is rates have come down. And so borrowers are refinancing just like you or I would refinance our house. We also have issuers that refinance their debt at lower rates, lower coupons, and then price. So components of a bond are priced. They are issued at par, they're redeemed at par. But as the market fluctuates, we've got prices change, coming back to that price yield. We have a maturity date. So we have the date that the bond is due. And then we have a function, it's a mathematical function. We'll talk a little bit more about it with regard to duration. And duration is a bond sensitivity to interest rates. Optionality or call features. So that's the ability for the bond to be called away from you earlier than anticipated and get your par back. And then a yield to maturity. That's probably the one number when you're looking at actually buying a bond, that or yield to call is what you're looking for to tell you what the bond is expected to return in the current interest rate environment. Any questions about components of a bond thus far?
Well, it makes me realize how complex a bond is. And unless you have experience and understand all these issues, it seems to me that a consumer should never buy an individual bond.
No, they really shouldn't. At the end of the day, this is after a decade trading bonds, right? I came to more of the financial planning, the individual investment management, and looked around. There's a lot of ways to invest money, not just the assets, but there's all sorts of vehicles. And the takeaway for me was the bond, to be able to trade bonds and to own bonds, you need to have a whole team in place to analyze that right column there, which is all the different risks associated with buying bonds, because it's just not as the idea that you could just buy something and hold it. Now, hindsight's always going to be 2020. Sure, there were great opportunities to buy bonds in the last 40 years. PIMCO made that was how they made their living. We've seen interest rates and tax rates come down dramatically over the last 40 years to the point of, I have to ask, if I could ask the audience is, do you remember the mortgage rate that you had on your home in the 80s? I just remember the story of my parents in their first home, and they got a deal at 14% on their first mortgage. My husband and I have never paid more than 5%, and we've been homeowners for about a decade, almost a decade ourselves. So, and again, that interest rate coming down, price has gone up. So holding bonds and buying them a long time ago, lots of value, good total return, new environment. We have credit risk. because right now we've got COVID, and while the market's up, and I have great things to say about that, we've got credit risk. Can they continue to make their bond payments? I don't know how many of you were in Orange County in the late 90s or mid 90s, I guess, when Orange County defaulted on their bond payments, right? And they were a AAA down to a AA credit, good credit. So we've got credit risk, we've got interest rate risk. So that's what are interest rates going to do? We've got prepayment risk. That happens in the mortgage bond section. So you know how your mortgage statement continues to change, your servicer changes? That's because a lot of times your bank or your broker is selling your mortgage and those payments to someone else. And then prepayment is going to refinance and paying that income stream down and starting a new loan. We've got reinvestment risk. So if you had bought a bond even a year ago, a year ago is when rates started to invert. So let's say 2 years ago, you could have bought a 10-year at, I think it was about 2%. So if you bought a bond and you got a coupon payment, and you took that coupon payment and you reinvested it, you could get a pretty decent yield. Right now, if you've got that bond still paying coupon payments, you got that coupon payment, what are you going to reinvest it in if you're reinvesting it in fixed income? So that's your reinvestment risk. Currency risk is what your dollars and global bonds, what they are. Currency risk is the value of your dollar or the currency that you've invested in if you're investing in global bonds. Inflation risk is what are your coupon payments? What is your par going to be worth? If you bought a 10-year bond today, what's that $1,000 in 10 years going to buy you? And then liquidity risk, and we see that in high yield bonds in particular, or some more of the complex structures, is what can you save it? What can you turn your bond around for? That was something we saw big in the financial crisis. I have
Julie, we had a question regarding Melrose bonds. When Melrose is paid off, is that the end of, if the bond is paid off, is that the end of Melrose payments?
That is the end of Melrose.
Okay.
So we never counsel against it, or for it, but you can actually pay your Melrose bond, your portion of that off. And I don't know why one would do that, but you actually can. You can figure out what it is and pay that, and it goes away.
Okay.
Versus your property taxes don't. Yeah, the rest of them don't.
Is the bond market just as transparent as the stock market? In other words, you can go up and see what the price was on a daily basis and et cetera, or is that more hidden?
You can. That's a great question. So it's not as widely reported, but after the financial crisis, one of the things that came out of one of the regulations came out was there's a tool called EDGAR, EDGAR, and you can go, in theory, you can go and price your own bond and see what it is, what it would trade at. The problem, honestly, is I think I've used the example before. If you've ever sold something on Craigslist, right? Either you want to buy something or you're selling something, right? So in the market for a couch, right? I want to buy a couch on Craigslist. So I go to Craigslist and I look around, and there's all sorts of couches. I can see 200 couches available. Some are going to be further away from me. Some are not in good shape. There's any number, and the prices are all going to different, but they're still couches, right? They're still something I could put in my home and I could sit on it. Now, is it something I want? Does it check all the boxes, which is I want a sectional, I want, whatever it is that I want, can I find that? And then can I find it in my price? And that's how the bond market works. It is also over the counter. It is not on an exchange. And so it is transactional. So it's not as transparent as the market, but ultimately they are improving the transparency for sure.
Okay, good answer. Thank you.
Thanks. Components of a bond yield. So this is basically a graphical interpretation of what we just talked about. What we have is we've got Treasury. Now I'm going to try this little pen here. So we've got, can you see? Oh, I have to do it over here. Yeah, you have to, the Treasury inflation protected security. So those were TIPS, where we've got a couple of components. We've got a term. So that's how long the bond is outstanding, or the maturity, right? We've got a real rate component. So the actual rate that it's getting, inflation and credit. And we also have we have a real rate, and we have this real term premium. So these are the two premiums for inflation protected. Treasury, when you're calculating the components of a bond yield, you incorporate inflation risk and expected inflation risk. And then in a corporate or a municipal, that's when you start to factor in credit, because the idea is the Treasury is risk-free because the US government can continue to print bonds or print currency to be able to pay the interest payments due with treasuries.
Julie,
yes.
Do you have any monies in treasury bonds or in TIPS for your clients today?
So what we have in our fixed income, we have about 12% in short-term high quality bonds, about 12% of 100% of fixed income, right? So we have 12% in short-term, and there are some treasuries in there. Otherwise, we are investment grade corporates. We are global bonds. We have then some more intermediate credits. And then we also have income seeking. Just about 12% of that is income seeking. And what that means is we're looking for income. But what we find with the income seeking bond funds or bonds, so maybe not high yield, but certainly income seeking, is they're more correlated to the equity market. So if I have a portfolio, and coming back to that slide where we're talking about what's the point of putting the fixed income, if I'm trying to reduce volatility, I have to be very careful that I don't put high income producing bonds in the portfolio and think that I'm reducing volatility. I have to know the risks.
Okay. And why is it important for the audience to know what treasury bonds are paying? If we're not going to be investing in them, why is it important to know what the interest rate is?
That is the base rate that everything else is set off of, all the way along the term structure. So that's exactly what you would want to know is what am I being fairly compensated for the risk that I'm taking? And I was thinking there was another component there, but yes, you want to be sure that you're being compensated for the risk that you're taking. And you want to be able to see, if the 10 years at less than 1%, something that tells me I'm going to yield 6 or 7%, that maybe even 5%, that's a buyer beware. That is a red flag to say, hey, that's way over risk free. What is it that what risk am I taking here?
What is considered risk free borrowing?
That would be, well, technically it would be your T-bill, your Treasury T-bill, which is.
And then everything is based off that.
Of that. Or I guess to your point, it would also be maybe your Fed funds rate. So whatever the Fed funds, they set the beginning and then everything trickles off of that.
So, but the vast majority of your client's portfolio in the fixed income area is in the corporate bond, high quality range.
High quality. Everything's investment grade right now. And like I said, even we swapped out of an income seeking fund recently because we know that it's just going in anticipation of volatility due to the election and COVID. It was first it was a reduction and then a removal completely, because I want that part of my client's portfolio to be resilient regarding market fluctuations. I give something up for that, right? If I want something, something resilient, I'm not getting the equity market returns that we got, but I'm willing to trade that off. And that's ultimately what everything, stocks and bonds, it's all a trade-off of risk versus reward, right?
Right, it is. And what's beautiful about it, though, is that you can just decrease your return by a very small amount if you have a diversified, appropriate asset allocated portfolio.
Yes. Yes. I think we'll talk about some fixed income approaches. So ways to invest in fixed income. There's a couple of them in particular. So when I think of fixed income investing, we've talked about bonds, and you certainly could buy bonds, right? Like I said, leave it to the professionals. So then what am I left with in terms of putting fixed income into my portfolio? So we've got some conventional management. So there's different approaches. The active or conventional investment approach assumes that prices are not accurate and that individual security selection can be executed profitably on a consistent basis. What does that mean? That means that people, traders, portfolio managers think that they can find misprices in the bond market and they can add alpha or extra returns, right? It relies on the prediction of selecting undervalued assets. The challenge with making predictions about the future is that investors, to implement a profitable trading strategy, must not only predict future events, but also predict how markets will react to those future events. And we can obviously point to COVID, we can point to the financial crisis, right? Where we all thought, hey, bonds are supposed to go up. They actually didn't. And for a little bit, COVID's not the best example. That's why I have to go to the financial crisis and say, yeah, we thought everything, stocks would go down and bonds would go up. They actually didn't. Now, they didn't go down as much as stocks, but they are not always completely inversely correlated. Now, that said, too, is I think a lot's changed in the last decade of transparency and a number of other things. And that's why we have seen fixed income do well. But then, of course, we've seen the market come back. But ultimately, conventional management generates higher expenses by period and through their trading costs and often risks. And then so if we're not using an active manager, then there's index management, right?
So more passive.
Passive, exactly. Indexing offers a number of investment benefits over a conventional approach. Broad-based indices offer better diversification. They have lower fees. They follow a more transparent investment process. So investors have a clear idea of what they're getting. The problem with indexing is that commercial index providers determine the bonds held in the index, right? So instead of a strategy factoring in interest rates and all those components of a bond yield that an active manager would do, an index, and I'm going to go to my next slide here, an index approach lacks flexibility. So index managers attempt to match maturity of a benchmark. They don't care about they're discounting the yield curve's current shape, right? So you've got some examples here, time period 1, 2, and 3, where we've got what is the yield curve can be, sorry, let me back up a step. The gray line is the yield curve. It plots different bond prices and yields across different maturities. In a normally sloped yield curve, longer maturities will have higher yields than shorter maturities. A yield curve may also be flat. So you've got minimal difference, right, between short and long-term maturities. The changes in the shape and level of yield curves provide information about differences in expected returns. So I'm going somewhere with this. Index fund managers will target a set of maturity for a given portfolio based on the maturity of the index that they're looking to represent. So a lot of times, clients will ask, short, intermediate, long. Where are you? Where are you invested? You asked me about, am I in treasuries? I said short term. Right. And so what that is those are those short maturities, right? And I'm choosing, but I'm using actually an index fund. I'm actually using the Vanguard short-term index fund because I can count on the Vanguard short-term index fund to be short no matter what interest rates do.
What do you mean by short, Julie?
So that means for Vanguard, that short-term intermediate fund, I think is 2 years or less, maybe 3.
2 to
and then
3
I would
years
say
in duration.
in duration, right? And I'll get to my slide on duration here too. So we've got so an index. It's great for its transparency and its low costs, but it's not always a one-stop shop where you could buy one index or maybe a 33, 33, 33 on. No, it doesn't work so well with that. So what we do is we use an alternative approach, and that's what dimensional is all about. There's an alternative approach to both conventional and indexing, and it's informed by a view that market prices reflect all available information. So one of the things that Fama and French, who are
first of all, Julie, explain what dimensional funds is so that people become a little bit aware of what that is, and then go into this.
Sure. So dimensional is a fund company, right? Like I used to work for
Vanguard,
Penco.
right?
Yeah, or like Vanguard, right? So back in the late 70s, Ken French and I cannot remember Fama's name at the top of my head right now. A lot of information going through. So these two guys were at the University of Chicago, pulled a ton of historical information, analyzed it, and they came up with something called the efficient market hypothesis, which is markets are efficient. There is no pricing opportunity. You can't, all information is public and available. Anything that's not reflected in a price is private information. And so they believe that markets are efficient. Okay, so when we, and they have the academic research to back it up. And then in the early 80s, they started dimensional funds based on this quantitative perspective on the market. A lot of times now you hear smart beta. You might even have some smart beta or some, what are Wisdom Tree? Wisdom Tree has some ETFs that are, you'll say smart beta rules-based. These guys were the originals. They've been doing it for 40 years now. They don't, there's a great quote about something great will come in the financial markets every 10 to 15 years. Every year you can count on a new marketing idea to come from the investment world, right? And the idea is that they've got this company and it's rules based, and I'm focusing on and what they pull together to develop their fixed income strategy, which is unique to, it's not conventional and it's not indexing, right? So we've got this alternative approach. We can use the information contained in market prices to understand which bonds have higher expected returns. So guided by this principle that markets are efficient, and any mispricing is because there's information available to be extracted. We look to academic research to gain insight into the dimensions that drive those expected returns.
So a regular consumer will not be able to use dimensional funds. They have to go through a financial advisor such as yourself.
Yes.
If you had to recommend a mutual fund for fixed income, who would you recommend?
If I knew nothing, I obviously would start at Vanguard, right? I think that they do, while indexing has its weaknesses, at the same time, I believe that the transparency and the low cost index options are good. And then of course, they do have their personal service. They have CFPs on their team, but they are the closest in terms of fiduciary.
But I'm going to cut you off in just a second. Yeah. You want Vanguard for the consumer, and you're basically indicating, because of the volatility in the market as far as income and yield is concerned, stick to low duration.
Yes, stick to low duration. So let's talk about we've got some drivers of expected return. What does this mean? It means that there's a lot that comes into play in how to value fixed income, but the three biggest drivers are duration, credit quality, and currency. It's almost like levers that you could pull or something to that extent. So we've got duration, like we talked about. It's a measure of the sensitivity of the price of a fixed income investment to changes in interest rate, right? Generally, higher duration bonds will have greater sensitivity to changing interest rates, right? So what does that mean? And I'm not good enough with a whiteboard, so I'm going to have you think about this for a minute. As imagine a 2x4 board, right? That you place on a pendulum, right? So it's equally weighted. And then if we put pennies on the board for where the bond is callable and what yields are, and what we'll wind up having is you'll see the pendulum to weight to hold up the pennies at the back end of the board. We have to move it, and that's a kind of a measure, a visual of what duration is doing. Is it doesn't always match up with the maturity of the bond. It has to do with it's a mathematical calculation that has to do with the sensitivity to changes in yield and prices and an impact on term structure.
It's very difficult concept to explain over a Zoom presentation. And we also had a question on price and the inverse relationship. I'm going to give it a shot. Let's say we have a bond fund short term that pays 2% at the present time. All of a sudden, I'm going to make this up. We get a new president, and all of a sudden, interest rates jump on short-term bond fund to 3%. So now, because that is paying more, those bonds that were paying 2% are worth less.
Right.
So that's the price and inverse relationship to duration and maturity.
Yes, I absolutely. And I would say that, so what do we do in those situations if we have a mutual fund? Well, ultimately, again, you do have a piece of your portfolio that has declined in value, but there's the reinvestment rate, right? And then there's vehicles in the bond market that adjust to interest rates as well. So there's ways around that, but at the end of the day, yes, you're going to see the value of your bond fund drop, but you're also usually going to see other parts of the portfolio outperform in those situations as well.
So for individuals who are watching this, if they look at their bond mutual funds, they should check what is the objective of that fund in duration, in credit quality, and whether or not it's anything other than U.S. currency.
Absolutely. You've got it. So we've got a little bit more on varying the portfolio duration. So changing, that sensitivity is how we, that's how you pursue the higher expected returns. The yield curve plots the different prices on the yield across different maturities. In a normally sloped yield curve, long maturities will have higher yields than shorter. A yield curve may also be flat, and they'll have higher yields, or an inverted. So when short-term maturities have higher yields than long-term maturities, which is something that we might see here, is the changes in the shape of the yield curve can be used to determine which bonds have a higher expected return. A variable maturity approach allows portfolios to target the point on the yield curve that offers the highest expected return. Index fund managers are not as flexible. They're usually tied to a set maturity. We also have credit quality, right? So similarly to differences in yield, among the tiers of credit quality provide information about expected premium. As credit spreads, or the difference between yield of different credit tiers, or again, we talked about that risk-free versus whatever rate you're getting, that's your credit spread. We can use the information to adjust an allocation. Portfolio's allocation to the tiers of credit can be managed as the credit spread. So the yield between the difference between the bonds of similar maturity but different credit quality grows wider or narrows through time, right?
Yeah, don't ever just look at yield. There's a reason that yield is higher than what you normally would think.
Right.
A lot of times it's the credit quality.
A lot of times it's the credit, absolutely the credit quality. And again, other expectations of what the market, what other managers or other people in the market think. I mean, right now is you've got half the population thinking one thing and half the population thinking of another, right? So yield curve, it changes through time. It's a collection of prices for bonds of different maturities. The yield curve can change through time as new information enters the market or investors' tastes and preferences towards holding different bonds adjusts. The yield curve adjusts. Changes in yield curve can be used to determine when bonds have higher expected returns. So yield curves can be observed in fixed income markets around the world. So diversifying in different yield curves, you can reduce the volatility of fixed income. And we just have a couple more slides here. This one was, there's a world of opportunity in fixed income. Viewing the world in terms of bonds produces a very different perspective on countries and regions as compared to their landmass, population, GDP, or even stock markets. So this pictograph shows the balance of the investment grade fixed income opportunities around the world, with the size of each country adjusted to reflect the relative size of its fixed income market. So I think this is really interesting to look at because I love, history and all this kind of economic stuff, right? So we're looking at the United States and then Japan there with it's surprising that the relative size of a country's bond and equity markets, one, are not necessarily the same. And then also that different regulations and preferences regarding capital structures and government funding lead to different outcomes, right? So it's just kind of an interesting.
Do you have do you have a mutual fund that invest in international bonds in your client's portfolio?
Of our fixed income allocation, 32% are to global core, a global core strategy. So it's investment grade, duration of about 4, maybe 3.5 years right now. And then it's a non-US. So we want to get that exposure, because stepping outside of the US is another, this is the lever that you can pull is, but we don't hold any emerging market debt in that fund. It's no emerging market debt. It's all multinational.
Yeah. Developed country. So if you went to Vanguard, you would look for international developed mutual fund. And what kind of duration are you looking at on the international front?
That's a great question, Pete, because with the mutual funds, you get to kind of suggest, right? Especially with Vanguard, you get to say like short, intermediate, or long. But what we're looking for in that global space is we do like the active management, or again our DFA management. But the idea is that you want a manager that can change the duration, can manipulate or make changes to, especially in a global portfolio. But to answer your question, right now, just staying short. So I'd say 3 years of duration is good. I should know what the index is at the top of my head, but I don't. But yeah, so I think about 3-4 years tops on that duration.
Yeah,
part of the portfolio.
Yeah, because in the bond area, there, it's very difficult to pick out the appropriate bond fund for an individual, and Vanguard is known for keeping prices very, very low, or as low as possible, and so that's kind of why because there's not a lot of gain in the bond area.
No, there's really not. Yeah. I was just looking at, a couple of investment grade bonds. If you held investment grade bonds for the last 5 years, it's under 5%, right? Is the total return. If you had bought a bond fund 5 years ago and just held it, the Vanguard investment grade, I think is about 5% on an annualized basis, which it's not that bad, but it's definitely not what stocks have done in the last 5 years as well. And then, of course, if we look at other segments of the world, we actually see even lower returns. So you have to know what your trade-offs are when building the portfolio.
I think that's why you got to keep in mind that yields are low across the board for everybody. And the purpose of the bond fund is to reduce volatility, and even out the return on an annual basis for liquidity purposes as well, because the bond is 3 times bigger than the stock market, and you can get your monies out of the bond area within 3 to 5 days.
Right. Absolutely. And I think, one of the things that, when you're working with a financial advisor, right, they're going to ask you questions about your goals, your financial goals, right? That's one of the things we talk about. And so, for the example of, and you'll see, there's retirement, that's a goal, but I think one of the other goals sometimes clients have is maybe college. I want to go to college, or I want to take a big trip. Sorry, let me think about retirees here for just a second. Is I want to take a big trip, and I want to take a big trip in 2 or 3 years. And what do I need to achieve that goal? And ultimately, that's where sometimes we want to be sure that cash flow, and we want to know what that is. But inevitably, and I used to have this all the time at PIMCO, because we manage money for some pretty high net worth individuals, right? Is inevitably there's not as much planning with what we were doing. You just get the call at the desk that says, hey, they want money, they want it now. They're going to take it from your muni side of the portfolio. Why? Because this is the most conservative, boring part of their portfolio, and there's no taxable. They could it was more tax neutral. But it always cracked me up was then I didn't really have much planning control. Now I have clients, and we talk. Inevitably, there's always that I need money now. And here we are, sure enough, there we were in March. We've got clients, we'd really try and coach them, but there's always 1 or 2 that go, oh, but I need the money now. And ultimately, that's what that fixed income part is for, because you certainly don't want to sell your equities when they're down, right? I mean, it's universal. Buy low, sell high, right?
And Julie, the other thing too is that, and we have a question right on point on this, is that the asset allocation for each individual, is that strictly science, or is it part art, part science? In other words, let's say, for example, if you have an individual that has a higher risk tolerance, has absolutely no debt, that individual may want a smaller portion of bonds in their portfolio.
Yeah, absolutely. I get that all the time, on both ends of the spectrum. I mean, when in the last cycle, when interest rates were, they've been low. I mean, at the end of the day, they've been low for the last 10 years, but they were creeping up into kind of like a new normal range there for a while. And I'll tell you all the time, clients say, I don't want bonds. I don't want any bonds in my portfolio. And then I've got clients that say, can you put more in there? And to your point, it's understanding the goals and the risk tolerance, and ultimately, what compromise do we need to have to be able to get the right portfolio and the right mix to help you at the end of the day achieve your goals, right? And I have a very risk averse client who would love to be 100% bonds if she could. The problem is that it's just not going to keep pace with inflation, and it's not going to get her where she needs to be. And so there's a lot of hand holding and a lot of explaining to say we really need to have some equities in the portfolio. And then again, like I said, I've got the other ones on the other end of the spectrum saying, where are we at? And I want all equities. And then I look at their portfolio and I go, you can't afford to be all equities, because I've done the back testing. I'm in my next life, I don't know if I come back as a quant, but I love the numbers and I've run them. And I've looked at the 70-30, so 70% stocks, 30% bonds, 80-20, 60-40, 50-50. And right now, 60-40 wins the day, right? Is actually taking more risk to get more equities in the portfolio doesn't always get us where we think it would by taking on that extra risk without adding maybe some alternatives or something else. But 60-40, the numbers, the Vanguard numbers show, is the way that we get that consistent long-term rate of return that allows us to draw what we need from the portfolio and then leave some for inflation and growth.
I have an individual client who presently is 92 years old, and we need to hire a caregiver for him, and which will run 24/7 and about $7,000 per month. And
that's a deal. You're getting a deal. Send me
exactly.
their number.
but he wants it out of income. He cannot. He can't spend principal, and there isn't anything out there that he has in a portfolio that gives him that income. And so a lot of it is emotional, because spending principal, he feels, is that it's going to reduce his net worth, and he has plenty of money to last him. He could spend $20,000 per month and not run out of money, but it's hard to spend money for him from income. One other question that we have is, what's the difference between government related and treasury fixed income?
Government related and treasury fixed income. So government, depending on what you're looking at, government could be non-US. So that could be, that could be Italy, that could be Spain. So that's what I think of when I think of
Fannie Mae, the mortgage industry. That's government related.
Yes.
But it's not a treasury. Treasury is actually borrowing from the government, right?
Yes. There's no Canada doesn't, and in the UK, they don't call their bonds treasuries. That is from the US. It's I don't know what they would call it actually locally.
Yeah, and it's totally safe because the government can print the money.
Yes.
They'll never run out.
They'll never run out.
Unless the printing press stops. So let's go to this next slide.
We've talked about global bonds and how, different yield curves, right? So we've talked about, we've really kind of been thinking, at least I've been talking, I haven't been saying it, but we're talking about US yield curves. Well, global bonds have different yield curves, right? And so they're not the same. Investors can potentially enhance expected returns by diversifying across many yield curves using global bonds, right? And there's the curve. But I just wanted to add, this kind of wraps us up with regard to global diversification and the pieces around, the levers that you pull and you want to be sensitive to when building that portfolio. So I have that appendix here, which that has a link right to that interactive chart, my contact information. We also, you asked about my website. So we've got planretire.com as the website. If you go all the way to get started, that'll tell you that we do 3 things to get started, and we will gladly do a complimentary retirement assessment. You just complete our survey. We have a phone call, and then we'll build you a personalized asset map. So that's out there for the participants today. Thank you for sitting through this.
We're not done yet, Julie.
Yeah.
I'm going to ask you some more questions.
Sure.
When should somebody be looking at investing in municipal bonds? What income tax bracket do you see people now looking at in order to get an equivalent yield in the corporate bond area?
That's a great question. I actually, hang on just a second here. Let me see if I can pull it up. So I'm in the middle of studying for another designation. And today we were talking about municipal bonds and being a California investor. So muni yields right now are about 1.8%, but their tax equivalent yields are and if memory serves me, it was made now a tax equivalent yield. We take the yield on a muni bond and then we multiply it basically by your tax bracket. So highest tax bracket in California right now is over 50%, right? So we take that 1.8, we multiply it, and we're getting something north of 4, south of 5%. Investment grade corporates over the long run should return about 5%. So we're almost to a break even. What does that mean? Is you asked me thinking what income or what tax bracket, and I say asset allocation says you might not be that interested in munis, right? Because the total return is not that compelling even on a tax adjusted basis. Now, stepping back a minute here is if you really wanted to know, I mean, what was it? Was 15 years ago plus that PIMCO lowered their minimum to have a separately managed municipal bond account. So if you just wanted, municipal bonds and you wanted your own account, you didn't want one of their bond funds, you had to have $50 million. So that's where I would say you've got to have some real net worth to need or want municipal bonds in your portfolio.
So for a married couple, they should be in somewhere in the 40% plus marginable rate bracket.
To be even thinking about it. And even then the economics behind it. And Scott always says, don't let the tax tail wag the investment dog, right?
Yeah, but it's so compelling to get tax-free income. People
Yes.
hate paying taxes. So
somebody understandable.
Yeah. So somebody who's making $400,000 plus as a married couple, maybe begin looking at municipal bond funds.
Yeah. I think one of the things that we'll look at sometimes is using a municipal money market fund. So you get a little bit of interest, right? It's not much these days. But sometimes, the emergency fund, that can be a good place for it. It just, again, it depends on where you're at and what to your point, if you're making $400,000 in income and you've got a portfolio that's generating dividends and interest, yes, you might want to think about replacing that with some tax exempt income.
Okay. When people begin looking for a bond mutual fund, it says in the Morningstar reports and Yahoo News and, that type of thing, what kind of yield did it have in the previous year? Should we pay much attention to that?
I think paying attention to yield is important. I was just going to look at past yield. Well, they always say past performance, right, is no guarantee of future results. I mean, you can.
Yeah, but it's probably more attuned to the bond mutual fund than the stock mutual fund.
Yes.
I mean, I find looking in the rear view mirror on bond funds is really dangerous.
I would agree with that. Sure. Yeah. I think that, especially right now, right? I mean, where things are definitely changing. And so I think your question was, would I look to past yield to determine future? And I think I would be really sensitive to that. And if I was looking at like a Morningstar, I was literally pulling up a Morningstar, kind of thinking about what would I look at there. If I wasn't looking at yield, I might look at a Sharpe ratio, which is risk per unit of return. And then I would look at tenure, right? How long has the fund been around? Because one of the things that they do in the, in the traditional way, the active world, is if a fund starts to underperform its benchmark, they just have a fund that is performing well, gobble it up, and they close it out. There's a big survivor bias in things.
Well, that's why I would stick to Vanguard. If you're going into bond fund, it's just a straightforward, inexpensive, go to quality and duration and stick there for my bond portfolio, if I was going to do it on my own and not with a financial advisor. My other question, since the bond funds are not paying a lot of income, are you doing timber funds or real estate investment funds to generate income for your client's portfolio?
It's a good question, and no timber funds.
No timber funds.
No timber funds. No commodities. REITs. We will allocate to.
What is a REIT?
No.
What is a REIT, Julie?
A REIT is a real estate investment trust, and they typically bundle investors' money together and hold real estate and directly. So and typically have a higher yield because oftentimes, depending on whether public, not so much, but the private ones that typically have that higher income, there's a lockup period. It's almost like maybe like a venture capital or an alternative investment sometimes, where there's just they can have a place in a portfolio for sure.
Are you using ETFs in the bond area for your client's portfolio?
We do have a small allocation to a JP Morgan ETF bond fund. Why? Because it's no transaction fee, and occasionally, and it's investment grade. It's nice and high quality. Occasionally, we might need a small amount for a client, or we're rebalancing, and it's nice to have something on the fixed income side as well as the equity side, where I can shave off a small part of something that they need. Maybe it's to round out an RMD or a fee, or maybe they don't need that much, but I can do that without having to rebalance the whole portfolio and generate a bunch of transaction costs. Yeah. Okay. But ultimately, I mean, it's becoming pretty they're becoming pretty interchangeable, but you certainly need to look at the ETFs, look at the expense ratios, and look at the manager objectives. What does it say? What are their duration targets? What are their maturity, credit quality, and then the liquidity available behind them as well.
Yeah. So we've been talking about rates in the bond area. Dawn, I'm glad you're back. What are some of, let's say I don't know if you have your charitable gift annuity rates handy, but what would be the rate for a 80-year-old today on a charitable gift annuity?
I'm going to make it a 75-year-old, if that's okay.
Sure, 75-year-old.
Because that way I have the example for it. So at 75, and there's a question that's been asked a little bit in here of how do we know that the necessary charity is stable and secure? And we have always said you need to make sure you use a large charity if you're going to do something like a charitable gift annuity. And because David Moore and I did the presentation together, I pick on David or I pick on Chapman to say, if you did a CGA with Chapman, you're basically guaranteed, I'm sorry, that's a bad word. You are assured, better word, that you're going to get the funds because they pledged the university. It has to be there. And I want to ask you one time, does that mean I can have my name on a classroom if I want to or something? But that's very important. But to your point, Dave, Pete, a 75-year-old, the rate that they're going to get is 5.4%.
And that's plus the income tax deduction.
Hang on. So that is a simple little 2-page contract that you do. No pressure, no sales, make it today or it's not going to be there tomorrow. That's the rate, and it's set for the rest of your life. Or if there are two of you, it could be for a dual life. Now, Pete let the cat out of the bag in that after tax, that is actually an 8.78% return, which isn't a bad return to get when you look at what bonds or even what equities are today. That's a pretty good return. The other piece of that, however, is, and I was using $100,000 just as a round number to use, you get $41,000 tax deduction. So you take 30% of your adjusted gross income and you start applying this $41,000 against it. And that's this year and 5 more years in the future. We did our charitable remainder trust in 2017. So we go to 2022. Each year since then, my wife has gone, why is our marginal tax rate so low? Because we get rid of 30% of our income, because we got a large tax deduction when we did our charitable remainder. And so not only do you get 5.4 for the rest of your life, you net of taxes get 8.87, but you also get a $41,000 in the case of $100,000 tax deduction, which in theory can save you an additional $13,000 according to all the calculations. So it's an interesting one to go through and look at as an alternative. Now, I will say, I would put up a CGA against a commercial annuity anytime.
Yeah.
But if you're looking at it as opposed to a bond fund, the trick becomes, number one, the charity gets the money when you pass. So you need to be charitably inclined. And if you're thinking, well, when I die, I want to do this. Well, you can look at something like a gift annuity and have the income now, the income tax deduction now. You automatically get the estate tax because the money's outside of your estate, but you will not get the money. Now, in several of the sessions we've done live, people have gone, wait, my children are going to kill me if I give it to charity. You're dead. They can't kill you twice. And there incidentally are ways around that. You can insure it, you can do other things to cover it. There is also the interesting aspect that people say, you can't get the money back, it's gone. It really isn't. There is, in fact, a secondary market that will go through and look at, $41,000 is your tax deduction, which means $59,000 in value. And that actually has a marketable value if you needed to have the money back. Yeah. So there are options, but looking at the numbers, it's like,
But first of all, you don't do a charitable gift annuity or make such a large gift to charity without, and this is what the whole program is about, without looking at what are your goals and objectives.
Do a plan. Yes.
What is your net worth? What is your income needs?
Right.
And this is not a sale of a charitable gift annuity.
No,
it has to fit.
It's an option
in your goals and objectives.
Right.
And the only group that I know that does this is the fee-only fiduciary registered investment advisors. And I love you guys. I wish you become more popular. People don't know how much they're paying their broker, and people don't understand the value you provide versus the individuals that do it themselves. And money is just a huge issue as far as control is concerned. But Julie, anytime you make a decision for your clients, are they in control?
Yeah.
Yeah.
Well, yeah. I mean, they put a piece of the control in my hands, but they are in control. And it's always, the first core value of our firm is autonomy, financial autonomy, doing what's best for our clients, putting them first. Absolutely. 100%. Yeah. I was going to add, just while we're talking about it, is the gift annuity. Can you add to that? I know with a CRUT you can add to later, but no, the annuity is the one, that's it for lifetime.
Well, you could do an additional annuity.
You could do a ladder. So there are people who will say, okay, I'm going to give this much each year, but you create a new one because the interest rate the interest increases the older you get. So you don't want to keep rolling it into a CRUT, in the case of ours, you want to be able to get a new contract at a higher rate.
Got it. Okay.
Not easy.
Yeah.
Julie,
Not
Julie,
easy.
go forward one slide.
Oh, what? So we've got
There you go.
my reading
So,
list.
incidentally,
You
there have been
wanted
a
to
lot
do
of
this on your own. Yeah.
there have been a
Yeah,
lot
go
of
ahead.
questions of where can I get a glossary, where can I learn more or something else. And when I was going through Julie's material, got to this and I thought, wow, she actually gave them a reading list. This is pretty cool. So if someone
Full
really
reading
wants to go
list.
look at this, now we're not suggesting you do all of this on your own. You should go to a fee-only fiduciary advisor. But on the other hand, here's some places you can start looking at and saying, what makes sense
If
in here?
you read that whole handbook of fixed income securities by Frank Cabozzi, then I would say you might be prepared to do this on your own. But
Yeah.
and that's honestly the only one on fixed income, and it's a doozy, obviously, but it's one that is in my stack. I've got a couple more of them, but then the others are the Lords of Finance and the Creature from Jekyll Island are about the Fed, and I feel like there's a lot of that's the backbone right now. And then Intelligent Investor is about, investing and value investing. So it's all good stuff. I think so. Scott saw the list and oh shoot, I should have remembered what he said. He does the Ascent of Wealth is his recommended reading. He has his students do book reports and that sort of thing. But if you like it and you're interested in more, there's some academic stuff, and then there's some easy reading there at the bottom.
Yeah.
Some light reading.
Yeah. I got in a question.
Thank you.
Why do I recommend
Yeah.
Vanguard over maybe a Schwab or a TD Ameritrade or some of the other custodians that are out there? And the reason why I recommend Vanguard is to people is that Vanguard doesn't have any other divisions where they sell insurance, where they broker stocks, etc. So they literally are commission-free mutual funds that believes that low prices is the best thing for clients. And I agree with that philosophy. And I don't get paid a referral fee or anything else from Vanguard. They are a little bit difficult to deal with because they're absolutely swamped at the present time. And everything has to be done online or by phone. Julie? And
Thank you, Julie.
Thank you.
you did a great
Thank you
job
very
in
much.
such a
Thank you for
difficult
having me.
area.
Next week is wrap up. And if several of you were asking about how to get into the charitable one, so I've sent over the links for that to the registration. So love to have you there tomorrow if you do those and watch Pete and Trevor do their material. You'll like the intro, the picture at the intro. I have found one for the two of them. So if nothing else, I need to remember.
I'm a little scared.
And thank you for telling me to turn on the recording. Several of you, David and others, were very nice, including Pete, to say, turn the dang recording on, Don. I'll remember tomorrow because it's worth having in the video. So thank you, Julie. Thank you, Pete. And I'm turning off the recording.
Thank you.